trap candle is by far the easiest and the fastest way to become profitable. And I'm not saying this because it sounds fancy, but I'm saying this because it actually changed my life and my trading after years of failing. So if it worked for me, it will also work for you. And if I could go back into time, the only one bad thing about this rule would be that I did not know about it sooner, because it would be so much easier. So let's just get into it. Okay, so in this video you're going to find out exactly how the trap candle rule actually helped me and how I managed to break out of that unprofitable phase of trading. So make sure to stick till the end. But before that, let me show you some of my profits. So a monthly profit using this strategy, so you can see how consistent it is in the actual market. And this is my profit over a few months. You can see I actually crossed $100,000 in profit in about 4 months, I think. So let's actually get into it. And another thing is that it works on forex, options, crypto and futures. And why is futures in the color, you may ask? So futures is what I trade and what I just found out works the best with this trap candle rule. So that's why I colored it right here. So if you want to try it out, just know that it works best on futures, but you can use it on every single of these, so crypto, option and forex. So the first thing that we just need to know is that we are going to trade in the first 90 minutes of the market open. So that is just the biggest volatility ever in the market is at the beginning and the first 90 minutes of the market open. So we are always going to choose a session. Let's say we have Asia, London and New York. I personally do New York, so we are going to choose one and trade for the first 90 minutes. And why is that? Because it's the most efficient time zone, so price is going to move the cleanest and the best in that time zone. Also, we are going to be aligned with the banks, institutions and the big boys that kind of help us see those trap candles that actually manipulate everybody, but we are going to come to that later. So that's really important that we are in the market when the big boys, banks, institutions are in the market. Also, one thing is easy to read price action, so that means that price action is going to be clean, not just choppy, because in the session there is going to be nice moves happening. So that's going to mean that we are going to be able to catch nice moves. Also, we do not want to 9 to 5 the charts, so we want to come in the session for 90 minutes a day, and we just don't want to sit on the charts for, let's say, 5 hours, because that is not good at all, because at that point we can just find a job. So before we actually get to what actually is trap candle rule, we are first going to see what kind of confluences we need to know about and what kind of rules are we going to need to follow. So the first thing is that we don't need a daily bias, so there is no need to some kind of figure out where the daily bias is or where the market is going to go for that day. We are just going to read for what is the market doing at that exact moment and where it wants to go. Also, the second thing is really important. It sounds dumb, but we will just simply react and not predict. So what the market shows us that it wants to do, we are just going to react to that. We will not predict that market is going to go up, market is going to go down. We are just going to react to what the market is actually showing us. And the third thing is that we will only master 2 concepts that actually drive the market. So no need for 5 different confluences, 2 different indicators, and then to kind of have some kind of mess on the chart so you can just execute a trade. It's going to be very simple with only 2 concepts, and that is also the thing why we can just execute it so consistently without any problems. And that is, trust me, very important, because there is never going to be too much thinking of if you should execute a setup or should not, because it's only 2 concepts, so it's very simple. So let's actually find out what 2 concepts are actually going to drive the market. So what are we going to trade based off of? So the first concept is fair value gap, so a imbalance in the market. It's pretty simple. We need 3 candlesticks, and the most important thing is that from the first candlestick to the third candlestick's wick is a hole, and that is literally it. We just want to see this imbalance from the wick of the first candle to the wick of the third candle. The second concept is going to be the liquidity. So I'm going to go a bit deeper into what the liquidity is, but it's also very important, and you are also going to see later on how we are actually going to use it and why it's so important. Okay, so let's first find out what the liquidity is on the chart. So in front of us we have just some kind of basic market movement to the upside. As you can see, market is just slowly progressing to the upside, and this is what we call market structure. And right now, if you look on the chart, we are actually in the uptrend. So what all people think is when they look at a market, they see higher highs, higher lows, and that is just a market structure that is currently in the uptrend and moving to the upside. So what will they do? They will just try to execute positions from some kind of their zones to the upside. So it's going to be pretty simple. They will just look for the buys in the market. And why is that good for us? So knowing that a lot of people, majority of people lose money in the markets when they try to execute the long positions like this to the upside from some kind of their zone, there is going to be the other side of traders that I told you already about, which are the banks, institutions, and the big boys. And what they want to do is they want to make everybody lose in the markets and actually kind of give away their money to them. So the point is that they will drive the market to sweep their stop losses, to manipulate them so they can actually enter the market and basically just take their money away. So how are we going to use that and see that on the chart to our advantage? So when we have the market structure to, let's say, the upside like this, we are just going to the upside. The thing that we want to see is lows and highs. So we have two lows right here. And why are they important to us? Because when the market makers, let's say, want to execute some kind of longs, before they do that, they're just not going to buy into the market like this. They want to see some kind of stop losses get taken out. And how do the stop losses get taken out? So it's pretty simple actually. If we just think about how the people are executing positions, if we think that a lot of people just enter the market out of some kind of zone right here, what is that going to tell us? That is just going to tell us that people are just looking for the buys to the upside. So what are market makers going to know? They're going to know that at this low right here and at this low right here is going to be a bunch of stop losses, because everybody is just looking for the opportunity to execute to the upside. So it's going to be pretty simple to them that they actually need to bring down the market, maybe do some kind of, I like to call it like a reaction, so the people are going to start massively buying right here. And then what is going to happen? Market makers are just going to start sweeping liquidity, or in better words, they're just going to start sweeping lows and highs. In this case, it's just lows. So after they actually sweep all the lows or some kind of low in the market, which is always going to be some kind of stop losses, because every single high, so this high right here, there were stop losses right here on this high, also this high, there was also stop losses right here from all the people wanting to short the market. So there is always going to be stop losses at every single high and every single low in the market. So when the market makers do some kind of manipulations where they sweep all the stop losses from everybody, they can even sweep this low down here like this, the people are going to think that this is some kind of break of structure towards the downside. So everybody is going to start shorting the market towards the downside, but then the market makers are just going to continue the true direction, sweeping all the liquidity to the upside and then just making new liquidity points like this and just continuing as they want. So in the end, to not complicate things anymore, just to clarify, liquidity is just lows and highs in the market, and it's that simple. So all we need to look for in the market is lows and highs, and that is just liquidity. And in this example, you can see beautifully how everybody would lose money, but we would actually make money, and I will come to that later how we would execute this. But you can see market came down, it kind of reacted off a zone, came down again into it, reacted off, and then came down again, reacted, came down again, reacted. So what does that mean to us? That means to us that at this point right here, so at this cube right here, is going to be so much stop losses. So what is market going to do? Market makers, banks, institutions, they are going to move the market to the downside, so they can actually move the market because they are trading with, I would say, trillions and trillions of dollars. So they will move the market towards the downside, and then after everybody is stopped out, when we sweep everything, then the true move is going to happen. That is going to be the move to the upside, that is this one right here. And we are always, but always going to wait for these manipulations to happen in the market, because without them, we are just going to become a part of that manipulation and we are going to actually lose money. And why do I call it the trap candle rule? Is because I want to wait for that trap to happen in the market where everybody gets swept out, and then we are going to actually move in the market, because we already know that 99% of traders lose money in the market, which means only 1% of traders are going to make something in the market, and that is why 99% are going to get trapped stopped out, manipulated, and then we are going to come into the market along with other 1% of traders. And here is another example of where the market is probably doing something like this. It's just moving to the upside, making break of structure to the upside. So everybody is just going to expect market to react from these zones and to just continue to the upside. So market is just going to come, respect those zones like this, and just bounce back off. And what is actually going to happen is that market actually swept liquidity right here, and everybody that is going to wait for the bounce of these zones right here is going to what? Is going to lose money like this. So you can see if they wanted to enter off of the fair value gaps, first fair value gap right here, it failed. Second fair value gap right here, failed. Third fair value gap, failed. But how we are going to think in the market, we are just going to kind of use the reverse psychology, and what we are going to do is we had the liquidity sweep right here, and we are not going to place some kind of buy limit orders and just hope that market taps it and then just rejects off of it. We are going to wait for the market to show us what it is going to respect and what it is going to disrespect. And if I show you right now what kind of trades will we be using, is these ones. So we are going to wait for the market to show us. So after the liquidity sweep, we waiting for the market to show us whether it's going to disrespect or respect this fair value gap right here. And you can see that the market with this closure right here told us that that fair value gap is not going to hold. Because how do we know that fair value gap is holding? If the price never closes below it, that's how we know that it's holding. And after we inverse it like this, that means that market is going to go to the downside, and that is how we are going to execute our positions. And then if you look at the other fair value gap, let's say this one right here, you can see the closure right here. That's when we execute the position. Stop loss above, you can see the fair value gap right here. That's where we put our stop loss above it, and then also we just wait for the trade to play out, and you can see how it went to the downside later. And then if you go back to this picture right here, you can see all the people just praying that market is going to bounce back off of their zones, which is just not profitable at all. And then us right here, who are just going to wait to actually see what the market is going to tell us, what the market is going to respect and disrespect. And I hope that right now you can see the difference and the simplicity and the profitability that this model can actually give you. And you can see my win rate last here, which is over the last 4 months, it's 83%. So positive risk reward, positive win rate, and that just means that we are going to get consistent results. So it's pretty simple. And before we actually hop into real charts, if you like the video till now, make sure to subscribe to the channel, like the video, because that will just make you not miss any of the videos, any of the new videos, and that will just make me know that I'm doing something good. So let's get into it. Okay, so here we are at the actual market. So if you right now look at the market, we can see that market came to the downside, then moved back to the upside and broke the structure. So it's pretty simple. We see that the market is just breaking structure towards the upside. So what is everybody going to think? Everybody is just going to be kind of crazy getting into longs. So there is going to be huge amounts of people entering long positions like this towards the upside, then just another ones right here, and just on and on and on. And what is that going to tell us? That is going to tell us that there is going to be a bunch of liquidity below that market is going to want to collect. So if you fast forward the market, let's see what the market is doing. So the market made new break of structure, or better said, liquidity sweep, because all of these breaks of structures are just market makers collecting liquidity. So there is going to be also short orders right here that were actually collected right here later on, and then it's just going to be the same thing like this to absolute infinity, because there is, I would say, hundreds of thousands of people who are going to short the market right there, and there is going to be a bunch of money at these highs and lows. So after we had these two liquidity sweeps to the upside, what are we going to do? We are going to wait for the fair value gap to be made. So we can see that we actually have a fair value gap right here, and we will also check if maybe there is new fair value gap made in the market. And you can see right here, fair value gap is made, and we are on the 5-minute time frame right now. So 5 minutes is completely fine to use. So right now all we are waiting for is, as I told you guys, we want to see a closure underneath the fair value gap. So somewhere right here we want to see an actual closure. So let's see if that happens. So we are just fast forwarding the market, and there it is. So we actually got the close. So all of these candles right here were not valid to enter, but then this one that actually closed below is the valid one. So all we do is enter the trade. We can put our stop loss above the high, above the candlesticks like this, and just target the downside. What do we target? We target the liquidity. So it's gonna be pretty simple. So I told you guys all the highs and lows are liquidity, and this is the market movement for right now. So what are going to be the liquidity points? This one down here, this one, and then this one is going to be the new one. So all we do right now when we execute the position on the closure, we target this liquidity down here, and let's see what is market gonna do. So market is just chilling, and there it is. So market just came beautifully to our TP for 2.6 risk to reward. And also it totally depends. If you want to place some kind of tighter stop losses, you can do that, but if you want to place them wider, you can also do that. So it's completely up to you. Okay, so here's the second example. So what we can see right now here is that market is trending towards the downside, and that is pretty clear. So you can see that market actually made, let's say, a break of structure right here, which is actually a liquidity sweep. We left a high here, and then what we also see is that market made a pullback right here, and then it's proceeding to go to the downside. So let's move this out of the screen. So let's see if the market is going to actually continue moving to the upside. Okay, so market actually made another liquidity sweep, which they are thinking is just going to be break of structure. So they are going to continue shorting the market, and what we are going to look for is the last fair value gap. It's going to be this one right here. So if we just wait for the inversion of that fair value gap, okay, so actually what we have right now is the thing that I told you about. We always want to look for the last fair value gap. So this is a small new fair value gap that was created, but it is still very valid. So we actually enter from this one right here. Stop loss, we can put it, let's say, underneath the candle's low, so we don't put it all the way down here for a better risk to reward. And then we just target liquidity to the upside, or we can target, let's say, 1 to 2 risk to reward, 1 to 3 risk to reward. It really doesn't matter. And let's see how the trade is going to actually play out. So you can actually see how it just beautifully swept liquidity and just played all the way to the upside. So on a simple $100,000 funded account with this trade alone, you could have made $3,000. So that is actually pretty huge for how simple it is. And that is basically it. That is the whole strategy. But before you leave the video, I'm actually going to give you something for completely free, which is going to be just a playbook of this strategy, which is just a 10-page PDF file where you can just see all the confluences and everything perfectly in order, so you can keep it by your side when you actually trade this strategy. Also, one more thing, if you learned something new in this video, make sure to subscribe on the channel, leave a like, and basically that's it. I'm just gonna see you in the next video. Peace.